Welcome everybody to our economic update. We're rebranding this as Finance in 15, and we changed up the format a little bit. So we tightened up the time, hopefully, and we broke it out into three areas. So the indexes and the macro outlook on the economy, the indicators that are driving the economies, and some implications and some things we might want to think about. So starting off, we wanted to cover a macro outlook and the general ongoings in the various markets and the indexes that we follow to track those. So when you take a look at the screen, this is last year's major indexes. Starting out, we see our S&P 500, so U.S. large cap stocks coming in just under negative 19.5%. Followed up by our mid caps, it was down just under 18%. The MSCI, our international index or international stocks, that was down just under 17%. And surprising to many, we saw the aggregate bond index, which tracks bonds in the US, down about 13%. That was the first time since 1970 we've seen a negative on both the S&P and the aggregate bond index. And when we change over and look at the year-to-date numbers, it changes the tail of the tape a bit. So you can see on your screen now we have the aggregate bond index has returned 2.6 so far this year. The Wilshire or the mid-cap or the middle-sized companies have returned 3.4. The S&P 500 has responded very strongly and returned an 8.23, and then surprising to many, the international index responded stronger than all the other indices at it's up 10.6 this year so far. So Melissa, we've seen a lot going on last year post-COVID in regards to inflation and how we responded to it. What are the main things you're seeing, and how is it affecting this economy?
Well, thanks for the recap, Joe, on last year and this year. Certainly, last year was a tough year for pretty much all asset classes, mostly due to what you just brought up, which is inflation, which shouldn't be a new story. I mean, we've been talking about inflation for over 2 years. It's all in the news now. Everybody knows that there's inflation. The big question we're getting is sort of like, why? Like, how did we end up here? And I mean, it's a complicated question, but to kind of boil it down to like the main reasons, it's not necessarily just because of supply chain issues or Russia, Ukraine, or the pandemic itself, and certainly not likely because of politics, but mainly it's because of the Fed policy in keeping rates very low for a long time, increasing the money supply, the government also continuing to stimulate by increasing demand by giving out PPP money, other benefits, as well as those stimulus checks. And what that basically caused is inflation to spike very quickly to 9% last year. And as a result of that, the Fed had a decision to make on how to tackle that inflation. And in order to combat it, they had to increase rates at a rate, no pun intended, that we haven't seen in a very long time. So, interest rates from the last year pretty much went from 0 to we're at 5% now. And that's been very difficult for stocks and bonds and other asset classes, as well as the economy, to digest. Kind of going back to what Joe said, the biggest question investors have is, well, they're used to an 18% they're used to an 18% correction in equities. They're not used to a 13% correction in bonds. So it definitely was a challenge. I mean, the good news is we did help insulate portfolios from a lot of those risks and get it prepared for that. But where are we today, and kind of what's our general outlook on that? Today, as Joe said, I mean, indexes are looking a lot better. Things are looking a little up and up. They've been up and down, for the beginning part of the year, mostly because inflation's trying to find sort of its bottom, and the Fed's trying to find the rate that keeps inflation at bay, but balances it with the risk of throwing, the economy into a recession. Most economists are calling for a recession this year. I mean, even the Fed has basically called for a recession. Of course, we don't know. We think it'll be relatively mild, but there probably will be a recession towards the end of the year. But as we near that, it's likely that stocks and bonds are going to reach a point where they'll be able to rebound and recover. And it's very unusual to have 2 consecutive years of negative returns in the stock market. I mean, not to say it hasn't happened. It happened in the 30s, it happened in the 40s, it happened once in the 70s and once in the 2000s. So it kind of remains to be seen what's going to happen this year. But I think overall, we feel like we're further sort of through this inflation crisis. than we are to the beginning of it. I mean, average bear market's 9 months. We're 14 plus months into this. We kind of anticipated it being a little longer just because of the nature of the problem. But the reality is that we want to be ready to take advantage of the rebound when it happens. The same way where when markets go down, we try to make timely changes to your portfolio to insulate the downside. We now have to be ready to be poised to take advantage of the upside in your portfolios. And Josh is going to talk a little bit about our general outlook on that and some of the changes that we are making and are going to be making here in the near future.
Thanks, Melissa. It's always a difficult thing to try to predict where we want to make our changes because obviously, as you all know, we don't have a crystal ball. That being said, we really do try to take our time to identify areas of opportunity. We like to call it timely and tactical adjustments. We're not trying to time the markets. We know that doesn't work. But there are some areas of opportunity that we try to position ourselves, both, as Melissa mentioned, on the downside, which we had a lot of wins there, and then repositioning ourselves for a potential recovery when that may come. Is it today? Probably not. But as we start to build a story for a recovery, there still are some things we can do. It's kind of like making lemons out of lemonade, and last year the markets were pretty sour, but that doesn't mean that there aren't some opportunities that we can do to try to put our clients and our portfolios in the best position. The first thing is we've already spent some time talking about how bonds had a pretty rough year last year, one of the worst years ever in modern economics. But the landscape has changed a bit. Number one, there's actually some money to be had in interest from bonds. So prior to rates going up, and when you owned a bond, you really didn't get a whole lot of interest in that bond. So why did we own them? Maybe more for a diversification factor, and although that didn't work last year necessarily, that still was an important reason. But we weren't getting paid to own those bonds. Today we are. And the benefit of higher rates is when you're the lender, and that's what you are as a bond owner, you get to benefit from higher yields, higher interest rates on those bonds. Also, we're buying them at a discount. So because they were down so much last year, we get to now buy these bonds that are potentially undervalued and are going to potentially pay more interest. So we're slowly moving back to our target range in bonds, and we were underweight in many of our portfolios in bonds specifically because of these anticipated issues, and we're kind of slowly building back bonds to target. From an equity perspective or from a stock perspective, we're changing some of the filters that we use to identify what stocks and what companies we want to own. Typically we use screens that will identify things like growth versus value. And for the duration of time previously, we have been relatively overweight in value. Value stocks tend to perform a little bit better in volatile markets compared to growth companies. And we're starting to change those screens. And actually what we're looking at is not necessarily owning growth or value, but own what we call quality. Quality screening is going to look for companies that are profitable, financially solvent, and have quality earnings. Essentially companies that we're not really as concerned about if there are potential credit squeezes or liquidity issues kind of stemming from some of the banking issues that we've seen. And although we don't think that the banking crisis that we've experienced thus far is systemic, meaning something that we think we could potentially bring down the entire economy, we are more interested in owning companies that may not be impacted by whatever ripple effects there would be from that issue. So we're kind of rescreening and repositioning the equity to own more quality. And quality is never a bad thing to own anyways. We're a little bit more favorable to international than we've been in the past. We've been highly underweight international for some time, and although we've owned some in our portfolios, it's been significantly underweight our target weightings. We're slowly starting to add that back in, and as Joe had shown you from the indices, they're not necessarily as susceptible to some of the volatility we're feeling here, because although they have problems, they're different problems, and we like to have a little bit more exposure to those areas. The other thing is we like cash right now. Not a lot, but we are taking off a small part of our equity exposure simply because we have already seen a little bit of a recovery. And although we're not necessarily bearish on stocks, I don't want to give that impression, we do feel that there's still some things that need to be worked on to start to build a full story to a recovery, and owning a few extra percentage points in cash while getting some interest that we weren't able to do before isn't a bad idea, so we can tactically readjust back into those equities when we feel that there's a very more conviction for a potential recovery. So we like bonds more than we did before. We like quality over growth versus value. We like international a little bit more, and we like a little bit of extra cash. So that doesn't mean that every single portfolio is going to have every single one of those themes integrated into it, but holistically, these are some of the ideas and some of the drivers that we're utilizing when we do reposition portfolios.
Great, Josh. Thank you. And to recap, so we saw some volatility last year, right? More volatility in the stock and bond market than we've seen since 1970. We've seen the highest inflation rate we've seen in our generation. We saw the Federal Reserve respond to that, and inflation seems to be back down to around 5% from 9%, so it's on its way down. And we've seen some opportunities pop up. We're able to make some money on our bonds now as far as the yield that we get. We're able to make some money on cash now. Do you guys, that was like the first 4% CD I've seen like
Ever?
very long
Yeah,
time.
it's been a long time.
In our careers, right?
Yeah,
So,
I mean, in some ways, I've been calling this sort of like the Great Reset because stocks aren't expensive anymore. Bonds are finally resetting to kind of a more normal situation, and we actually can finally get some yield. So
Totally.
in a lot of ways, it's going to be easier for us to create portfolios for clients that are more stable with more income. That's, as we both know, I mean, we all know that's been a challenge for the last basically 15 years.
Yeah, that's a great silver lining, for sure.
So, I mean, I think it seems like scary times to people, but nobody really likes it when the markets go down or when their portfolios go down, but I do think we're headed in the right direction, and there's a lot of things that we can take advantage of. But in general, I think if people are feeling like fearful or they have questions, they're always welcome to call us, and we're happy to explain it. And hopefully this was a short way to do that today. So.
Absolutely. So we are through tax season, thank goodness. Yay. It's the day after tax day. So we'll be getting a hold of folks for their review meetings if you're a client of ours. If you're not and you'd like a second opinion, please reach out to us. We'd be happy to give you one. And other than that,
we did it. Less than 15 minutes.
Less than 15 minutes,
all right,
guys. So we'll see you next time, and thank you all very much for joining us.
Thank you.
Thanks.